thank you for joining us once again here at Seafried & Brew for our economic briefing. Hi, I'm Jamie Sumner, Chief Analyst, and for this briefing, we just want to review over the last week in the market, and it seems like we had a little Chicken Little event here where the sky is falling, and we saw that happen last week with the significant decline in the stock market as well as the fixed income market. And overall, when we look at it, it's all due to this coronavirus scare and how it has been pushing through the world right now. And at the beginning of February, we had The Economist came out, asked that question, how bad will it get? And we're starting to see this roll through the economy now with China and just starting to get back online with some of their factories. But we see the rollout throughout the world, including the United States. And this weekend, we had that first death in the United States because of the coronavirus. And we start to see more and more community coronaviruses pick up right now. So we'll see how that progresses throughout the week. And we know that the CDC came out and said last week that it's not a question of if it will spread throughout the United States, but a question of when and how severe. So we have to see how it's going to roll throughout the rest of this week and then also next week, and hopefully peak out somewhere. But the question is, how bad will it get? And coming off of last week where we were down 16.3% on the Dow and the 10-year down to the 1.1%, it seems like it's fairly significant. The market, when it reacted sharply. But we got to remember, we will come back after this. You look back at the end of 2018, beginning of 2019, we saw that sharp decline in the Dow coming down 15.6%, but then we did make our way back up. So we continue to go through these cyclical processes here, and while we've come down a lot, it will ultimately pick back up when we move forward and get out of this time period with the coronavirus. But the big news is that 10-year Treasury dipped close to 1% this morning. We're back up to about a 110, and the question is, will it fall below that 1% mark throughout the week? On the short end of the curve, though, the eyes on the Fed and what they will do at their next meeting coming up this month. And when we look at the trend in terms of the distance between the upper and lower bounds and that 2-year Treasury and the 3-month Treasury, and you'll notice there's a fair amount of consistency when we walk through these throughout history, going back to 2014. And if you were to continue this back, you'd come up with the same consistency where typically the 2-year is above the upper bound and the 3-month falls above or right between the upper and lower. And now where we are today, if you look down here, that 2-year Treasury fell significantly throughout the past week. We're well below that lower bound, and that would suggest that the Fed would be considering lowering that target rate. And in fact, we look at the 5-year Forward, and we continue to see a downward momentum here. So we saw the short end of the curve reacting sharply, the long end of the curve reacting sharply, and this was the risk of that downward rate movement. Here we have CME Group coming out this morning, and look where they're putting it, 100% probability for that March meeting with a 50 basis point cut. We're not talking about a 25 basis point cut here. This is a 50 basis point cut coming down to the spread of 100 to 125 basis points. That is a significant change from where we were, even if you went back just 2 weeks, how this forward or the implied probabilities are looking. So this would be significant if they do, in fact, come down by that 50 basis points. And we saw that, with this kind of trend, it is realistic that we could see that type of movement over the next couple of weeks, especially when the Fed meets on the 18th. The bigger question, though, is if we were to see the 10-year continue to drop, the impact to mortgage rates and how that is going to filter through the refi phase that will be coming. And we have to take a look at that within our AL models and see what's going to happen if we begin to see these mortgages start to prepay and refinance at significantly lower rates. We are at the point that just about every mortgage out there has that refi advantage right now. And so we're going to see, and as we go and meet with banks throughout the quarter, how that's going to play out. And also looking at that mortgage-backed security market and see if we begin to see this uptick in these prepayment speeds. Well, that's what we have for you today. We look forward to talking to you next week when we review over the unemployment rate that's coming out at the end of the month, or at the end of the week for February. Have a great week, everyone.